Remember when we did the fiscal policy chapter, we looked at how to change government spending and taxes in order to correct a recession or inflationary situation. This chapter we're going to look at using monetary policy, which is a change in money supply, to fix those same situations. It might be that our best policy is to use fiscal. It might be that the best choice is monetary policy. Often it's a combination of both. We'll start out looking at interest rates and looking at how the demand and supply of available funds, available money, dictate equilibrium interest rates. We'll look at the Fed's balance sheet. In the last chapter, we looked at commercial banks' balance sheets. We saw their assets and their liabilities and how different transactions affected the commercial bank's balance sheet. And now we'll add the Federal Reserve's balance sheets in and look how different transactions in monetary policy affect both the Federal Reserve and commercial banks' balance sheet. We'll look at all the tools of monetary policy, what the Fed hopes or their targets will happen, and then we'll look at, when we use monetary policy, how does it affect the real GDP and the price level to get an overall big picture. This chapter really ties together all you've done this semester. We talk about interest as if there's just one interest rate when we're in this class, but in truth, you know all the different interest rates. You have an interest rate on your car if you owe money on your car, or an interest rate on your credit card, or an interest rate on your home if you own a home. All of those are different amounts. And then on the flip side, instead of interest you pay, there's interest you earn. But for the purposes of our course, you want to think of interest rates as the price paid for the use of money. So the price paid for the use of $1 for 1 year is the concept of what an interest rate is for our course. It really helps if you focus on the interest paid. Try not to think about the interest earned as you're working through this chapter because it'll make it more confusing for you. So think about why you want money. Why do you want money? Well, we want money to buy stuff, right? That's the transaction demand. So we're thinking about how much money we want to buy stuff, the transaction demand. We're really thinking about our income. How much money do we have? We're not really thinking about what the interest rate is. But there's also a demand for money that's the asset demand for money. Do you have money that you just set aside and you want to hold it? You may even want to hold it as cash, but it's just to have it for emergencies or for savings in whatever form, but I'm talking about cash in this case. Some people will take a $20 bill or a $100 bill, depending on your income, and they'll just tuck it away somewhere. That's the concept of an asset demand for money. That demand for money really does vary with the interest rate. As you think about the asset demand for money, I used to work for a man who kept $10,000 in a filing cabinet in our office. And he would say to me, I want you to know that this money is here in case I would be out of town and you needed to make a large purchase of some sort. So I wasn't assigning authority on the checking account. He didn't want me to be that. He just wanted me to have access to money if I should need it for whatever purpose. So he left $10,000 in that file cabinet. That's the asset demand for money. If you think about if interest rates had gone really high and he could have, and this time I'm talking about earned a high interest rate on that money, then he probably wouldn't have left such a large amount just sitting in a filing cabinet not earning interest. So when we say that the asset demand for money varies with the interest rate, if interest rates go high, we don't hold as much as an asset. If interest rates go low, then we might as well hold it just as an asset because it's not going to earn much anyway. So asset demand for money varies inversely, meaning as interest rates go up, how much we'll hold as an asset goes down. When we add the transaction demand and the asset demand for money, we get the total demand for money. Do you remember the three functions of money that we studied 2 chapters ago now? We said one of them was as a medium of exchange. One function of money is a medium of exchange. That's what the transaction demand for money is aligned with. And then we said another function of money was as a store of value, and that's the asset demand for money. We're just going to hold it so that we can use it later. We're going to add both of those together to get the total demand for money. So this is just a graphic to say exactly the same thing. The first graph is going to be the transaction demand. The second is going to be the asset demand. And lastly, we'll have the total demand for money. On each of these graphs, interest rates on the vertical and the quantity of money is on the horizontal. We said the transaction demand did not depend on the interest rate. So regardless of what the interest rate is, we're just going to hold. This is $100 billion. So this would be all of us cumulative in the nation. That much money would be how much we were demanding, the amount of money we were demanding to spend, to buy our stuff with. But the asset demand for money, we said, was dependent on the interest rate. So the asset demand for money is an inverse relationship between the interest rate and the quantity of money. So as high interest rates, then not much money is demanded to be held as an asset because there's such an incentive to invest it, put it in an interest earning account somewhere that would get that high interest rate. But as interest rates go down and near zero, as they have been for a while as far as interest rates you could earn on money, then there's not much incentive to hold it as an asset. So when we do this total demand for money, all we're doing is adding the transaction demand to the asset demand. So the slope is going to be the same as the asset demand, and we're just going to shift the asset demand over by the amount of the transaction, which was 100 billion here. So we get that total demand for money, then where you had a horizontal intercept of 200 for your asset plus the 100 for transaction, now it intersects at that 300 point. You're not going to have to graph this, so that's really maybe more detail than you want. But I do need you to understand that there's a total demand for money that's made up of both transaction and asset demand. Now, let's look at this red supply of money. So the supply of money is determined by the Federal Reserve. So money's supply is whatever the Federal Reserve says it is. So when we're thinking about the supply of money, I want you to realize that it is a vertical line. It's simply set by the Fed. When the Fed wants to increase money supply, it'll shift to the right. When Fed wants to decrease money supply, it will shift to the left. Okay? We're going to study all through this chapter how the Federal Reserve can increase or decrease money supply. So when the Federal Reserve sets money supply here, the example is 200 billion, then where the money supply intersects the money demand curve is this equilibrium interest rate. So we would just come out here and see what the interest rate was, and that would be the interest rate that we would be looking at when the supply of money was 200 billion and this was the total demand for money. But what if the Federal Reserve increases money supply? Then what would happen? Well, if the Federal Reserve increases money supply, it shifts this supply of money to the right. What do you see happen to interest rate? Where would you see it intersect? Well, it'd be somewhere down here on the curve, right? And down here we have lower interest rates. If the Federal Reserve decreases money supply, then it shifts to the left, and so it would intersect somewhere over here, and that increases interest rates. So the equilibrium interest rate is where the supply of money and the demand for money are equal. The interest rates and bond prices, okay? So if we think about bonds that pay a fixed annual interest rate, as the bond price goes up, then the resulting interest rate is going to be lower. As the bond prices go down, then the resulting interest rate is going to be higher. It's just a mathematical formula. So you need to know that bond prices and interest rates are inversely related. As one goes up, the other goes down. So it's time to look at the Federal Reserve's balance sheet. So they're going to look the same as they did for the commercial banks. So you're really going to have to pay attention up here. Does it say Federal Reserve up here, or does it say commercial banks? We wouldn't be talking about one commercial bank. We'll be talking about all the commercial banks, consolidated banking system, or the entire banking system. Remember, we had assets on this side, and we had liabilities on the other side. So we've got assets, and then we had liabilities over here. Liabilities and net worth. When you add the liabilities and the net worth together, you have to equal the assets. You have to keep both sides over here in balance, okay? Just going to stop writing there. So the assets that we're going to talk about on the Federal Reserve's balance sheets are going to be securities. So remember, when we have securities, we're talking about government bonds. That's a G. Government bonds. U.S. bonds. So if the Federal Reserve is selling bonds, then the securities account will be going down. If the Federal Reserve is buying bonds, then the securities account will be going up. Another asset, we said the Federal Reserve was the lender of last resort to banks. So loans to commercial banks is an asset because it's money that the banks are going to have to pay back to the Fed. So keep in mind, these are loans, but they're loans to banks. All right, and then the only liability that we actually work with over here is this bank's reserve account. So remember, we talked about the reserve account for a bank was the bank's checking account with the Federal Reserve. When we looked at the bank's balance sheet, the reserve account is an asset to the bank because it's money they own, but it's a liability to the Fed because it's money they owe to the banks. The reserve account is the bank's checking account. Our checking accounts are assets to us, but checkable deposits was a liability on the commercial bank's balance sheet because checkable deposits is money that the banks owe you and I. So think of the reserve account the same way. It's an asset to the bank. It's their checking account. It's money they own, but it's a liability to the Fed because they owe that money to commercial banks. So this is reserves, the bank's reserve account. Now, Treasury deposits is over here too. That's just the money that's in the U.S. government's checking account. We never touch that in any of our problems that we're solving. The Federal Reserve notes outstanding is really interesting, but we never touch it either. So if you look at the top of your money, it'll say that it is a Federal Reserve note. A note is a debt. So every dollar bill you've got in your pocket is a debt of the Federal Reserve. So all the money in circulation turns out to be in this Federal Reserve notes outstanding. That's a really interesting number. You can see how much money is in circulation when you look at the real numbers, but we don't touch that account. All we touch is the bank's reserve account. You need to understand that when the bank's reserve account changes on the bank's balance sheet, it's going to change here on the Federal Reserve's balance sheet. If the banks are getting loans from the Fed, it's going to change on the bank's liability side, and it's going to change on the Federal Reserve's asset side, but they're the same account, so keep up with them. So you don't have to look at my hen scratching. Here it is, all typed out neat. This is the actual balance sheet for the Federal Reserve. Remember, there are 12 Federal Reserve banks, but this is, we're going to look at them as if they're just one entity. So we have assets on the left, liabilities and net worth on the right. The only two accounts that we deal with on the asset side is securities. Remember what's in that securities account. So that's government bonds, right? Here we go. So this is government bonds. When they buy or sell government bonds, the securities account is going to change. I wish the count actually said bonds so that it wouldn't be so confusing for you. But securities is just the correct word to use for holding all of those government bonds. So on the asset side, we deal with securities because the Fed buys and sells securities to change the money supply. But the Fed also makes loans to commercial banks. Make sure you realize this is loans to commercial banks. So it's not to the public. It's not loans to you or I. It's loans to the bank. So it's an asset to the Fed, but that same account is going to show up on the commercial bank's balance sheets, and it's going to be a liability to them because when the bank gets a loan, they have to pay it back to the Fed. That's a liability, something they owe to the Fed, but it's an asset to the Fed because it's money that they're going to get. And then on the liability side, the only account that we work with is this reserves of commercial banks. So you're changing this on the commercial bank's balance sheet. It's an asset to them. It's a liability to the Fed. It's the same account. So when something happens and it changes the bank's reserve account, make sure you change it both on the commercial bank's balance sheet and on the Federal Reserve's balance sheet. And then we don't deal with Treasury deposits at all. We won't be working with any of these accounts. This is just a different name for the central banks. We call ours the Federal Reserve. We talked last chapter about, well, I guess 2 chapters ago about why that is. But ours is the Federal Reserve, set up in 1913. Austria calls theirs the Reserve Bank. Most countries just have like the Bank of Canada or the Bank of Japan or the Bank of Mexico, the Bank of England. But a few other countries do use the term Reserve Bank. So now we'll begin to really discuss the tools of monetary policy. So there are 4 tools of monetary policy that we're going to talk about. The first is open market operations, and that means buying and selling of government bonds. Let's see if I can get that. Buying or selling government bonds. So the Federal Reserve can buy and sell government bonds to increase or decrease the money supply. So when the Federal Reserve buys government bonds, it will increase the money supply. When the Federal Reserve sells government bonds, it will decrease the money supply. Do you remember back 2 chapters ago, we talked about the Open Market Operations Committee? There was a committee of 12 people. All 7 of the Board of Governors are on that committee. And then 5 of the 12 bank presidents also serve on that committee. The New York district president is always on the committee because open market operations are carried out in New York. That committee is very powerful because they are changing the money supply as they decide how much government bonds the Fed should buy or sell to get the money supply where they believe it needs to be to correct any recessionary gaps or inflationary gaps or just promote growth, keep unemployment low. Another tool of the Federal Reserve is setting that required reserve ratio. Remember, we talked about one of the functions of the Fed was to set this required reserve ratio. We looked and saw that most banks are large banks and are subject to a current 10% required reserve ratio. Small banks weren't subject to any. Medium size were subject to 3. We looked at that slide, I think, 2 chapters ago. So the Federal Reserve can change the required reserve ratio. When they do, it will affect required reserves, how much the bank has to hold, therefore it affects excess reserves. But think about what the formula is for the money multiplier. The formula for money multiplier is 1 over the required reserve ratio. So when the Federal Reserve changes the required reserve ratio, it changes required reserves and excess reserves, but it also changes the money multiplier. Just a moment. Let's finish writing money multiplier here. I'm just going to abbreviate that. So let's think about how that would work. So if they increase the required reserve ratio, if the Federal Reserve increases the required reserve ratio, then it's going to increase required reserves. it will decrease excess reserves. Remember, the money multiplier is 1 divided by required reserve ratio, so an inverse relationship. So it will decrease the money multiplier. So when the Federal Reserve raises the required reserve ratio, they're going to be decreasing money supply. If the Federal Reserve decreases the required reserve ratio, then banks won't have to hold as much money, and so they'll have more excess reserves, and that money multiplier will be bigger. So that will increase money supply. The discount rate. So the discount rate is the interest rate that the Federal Reserve charges banks to borrow money from the Federal Reserve. So we said banks have to meet their required reserves. Every day they have to meet the required reserves. If they can't meet the required reserves, then banks have to borrow either from another bank or from the Federal Reserve. We said the Federal Reserve was the lender of last resort. So a bank will first try to borrow from another bank. If they do, they'll pay an interest rate called the federal funds rate. If they can't borrow from another bank, they'll have to borrow from the Fed, and the interest rate that they pay is called the discount rate. Changing the discount rate is more of a signal of what the Fed wants to do rather than very effectual in the change itself. The theory is if they increase the discount rate, then banks won't borrow excess reserves, and so that will decrease the money supply. If the Federal Reserve increases the discount rate, we would expect the money supply to decrease. If the Federal Reserve decreases the discount rate, then the theory says, well, they might borrow excess reserves to loan out, and that will increase the money supply. It's really just a signal. Banks don't borrow excess reserves from the Federal Reserve very often. A new tool of the Federal Reserve is to be able to pay interest on the bank's reserve account held at the Fed. So this is interest earned by the banks from money they have held at the Federal Reserve. So if the Federal Reserve wanted banks to not loan so much money out, then they could offer to pay more interest on the bank's reserve account at the Fed. That would incentivize the banks to just leave their money at the Fed, not make so many loans, and that would decrease money supply. If the Fed wanted the banks to loan more money out, then they could decrease the interest paid on reserves and then that doesn't give the banks an incentive to hold money at the Fed. It gives them an incentive to take the excess reserves and loan it to the public where they can make more money. And when they make more loans to the public, that will increase money supply. So just going back through this list, I want you to know that open market operations is the most frequently used tool of the Federal Reserve. They can do this very specifically, how much they want money supply to go up. It can be small changes that they can make happen on a daily basis. Remember, if Congress wants to change fiscal policy, they all have to agree. 535 members of Congress all have to agree. There's only 12 people on the Open Market Committee, and they're all economists. They're not politically motivated. So generally, they all know exactly what needs to be done. They might disagree on how much, and so they'll talk about that for a bit. But open market operations is very quick and easy to implement. So it's very frequently used. Changing the reserve ratio is very powerful, but not frequently used because it is so powerful. When we change the reserve ratio, we change both excess reserves and the money multiplier. So it's kind of, the phrase is killing a gnat with a hammer. It's a very blunt tool. And so when we change the reserve ratio, it would have to be widely needed before the Fed would take such a huge step. I don't think it's changed since 1992. The discount rate is more of a signal than it is a tool for changing the money supply. So if the Federal Reserve wants to signal that they're going to be increasing the money supply, then they'll decrease the discount rate. And then we talked about the interest on reserves being the newest tool of the Federal Reserve. These slides just begin to give you more information on all the tools that I've already discussed with you. The idea is the more you hear it, the more it will begin to sink in. It helps to have some repetition when you're learning something you've never seen before. So remember that open market operations means buying and selling of government bonds, different securities. The Fed could buy or sell from commercial banks or the general public. We looked at that pie chart at the end of last chapter that showed who owned portions of the government debt. The government debt is financed through these government bonds and T-bills, different government securities. Well, the public owns some, commercial banks own some. So the Fed can buy or sell their securities to banks or the public. It matters to you which way it works, because when you're changing the Fed's balance sheet or commercial bank's balance sheet, if you're doing a transaction that affects the public, that the public bought or sold some of these securities, then that changes our checking accounts. Our checkable deposits change, which changes required and excess reserves. Whereas if the open market operations are carried out between the Fed and commercial banks, then checkable deposits doesn't change. So required reserves doesn't change. The purpose of open market operations is to increase or decrease the money supply. When Fed sells securities, the Fed sells a security, let's say to the bank buys securities, but they have to pay for it. So some of the bank's reserves then are given into the Fed to pay for those securities. That's going to reduce excess reserves, reduce lending ability, and it will, through a process of time, decrease the money supply. If the Fed buys securities, then the bank would give the Fed some of their securities, and in return, the Fed would pay for those securities by increasing the bank's reserves, which would all be excess reserves that could be loaned out. That would increase money supply. So this is Fed buys. Fed buys. Always start your sentence with what the Federal Reserve is doing. Fed buys, Fed sells. That helps clear it in your mind if you don't flip-flop back and forth between the Fed and commercial banks. So Fed buys from commercial banks. So under the commercial banks, the second one, balance sheet down below, notice the pluses and minuses. So Fed buys some of the securities. So there's a minus sign in front of the securities for the banks because the banks are selling them. So their securities are going down. The Federal Reserve's securities are going up because Fed bought some from the banks. Then the Fed has to pay for it. So the Fed puts more money in the bank's reserve account. So you see a plus sign in front of the bank's reserve accounts on both balance sheets. Notice that securities and reserves are both assets at the commercial banks. Securities and reserves are both assets for the commercial banks. So you can keep the balance sheet in balance by increasing and decreasing securities and reserves by the same amount. At the Federal Reserve, the bank's reserves are a liability to the Fed, an asset to the bank, but a liability to the Fed. So when the Federal Reserve buys bonds from commercial banks, then the securities account goes up, that bond account goes up, and commercial banks' reserves go up. You'll be doing this a lot on your homework, so it's important that you follow this through. Look at the plus and the minus sign. Fed buys from banks. So bank has less securities, Fed has more securities. Fed has to pay for them, so the reserves go up. So this is a graphic showing a more specific example of Fed buying a commercial bond from a commercial bank. So they're buying a $1,000 bond from the commercial bank. So they have to pay for that. The Fed has to pay for it. So they increase the bank's reserve account by $1,000. That $1,000 is all excess reserves because the public's checking account was not affected. How does that $1,000 become $5,000? Well, that's the money multiplier. So what is the money multiplier? Well, the reserve requirement being used in this chapter is 20%. So if the required reserve ratio is 20%, what is the money multiplier? Well, remember the formula is 1 over the money multiplier, so it'd be 1 divided by 0.2, and 1 divided by 0.2 is 5. So the money multiplier is 5, so that 1,000 times the money multiplier. Do you remember the formula? Maximum money creating potential was excess reserves times the money multiplier. So 1,000 times 5 gives a total change in the money supply of $5,000. Sometimes the Fed isn't buying or selling with the commercial banks. They're buying and selling with the general public. If that's the case, then it's going to touch the public's checking account. And when it touches the public's checking account, it's going to change required and excess reserves. So the Fed buys this $1,000 bond from you or I, somebody in the public. They pay us with a check. We deposit it at the bank. When we deposit it at the bank, that affects checkable deposits. The checkable deposits just went up by $1,000. Remember, the required reserve ratio was 20%. So 20% of that $1,000 goes to required reserves. So 1,000 times 0.2 is required reserves, $200. The rest of it would be excess. So 1,000 minus the 200 gives us 800 excess reserves. The money multiplier is still 5. Remember, the 5 times the excess reserves means the bank can expand the money supply by $4,000 from their increase in lending. The initial check was $1,000, and so when you add it together, the total increase in money supply is still $5,000. Now, instead of Fed buys, Fed sells. So this time, Fed sells bonds to the bank. Fed sells. So Fed selling bonds, the commercial bank is going to get more bonds. That's their securities account. So the Fed securities account goes down, the bank securities account goes up because the Fed sold them. When the Fed sold the bond to commercial banks, the banks had to pay for it, so they had to take money out of their reserve account. So the reserve account goes down. Remember, it's the same account. The liability at the Fed to the asset to the bank, that's the same account. So it's going to go down by the same amount. That account will always be the same number. When Fed sells bonds to the public, it has the exact same effect as when Fed sold bonds with commercial banks, since writing a check, if you remember back to the last chapter, decreases both checkable deposits and the bank's reserve account. Let's look more specifically at changing the required reserve ratio, that ratio set by the Fed that the banks must hold, that percentage they must hold of their checkable deposits. So if the Fed changes the required reserve ratio, then that percentage that's multiplied against checkable deposits will change. That will change excess reserves. And because the money multiplier is 1 divided by the required reserve ratio, it will also change the money multiplier. Let's look at an example on the next slide. So this is the effect of changing the reserve ratio. So that first column gives us different reserve ratio. If it's currently 10, changes to 20, 25, 30. And somebody deposits that $20,000. So we have $20,000 in checkable deposits. Required reserve ratio of 10% going along row 1. Then 10% of that $20,000 is required. So 10% times 20,000, required reserves will be 2. If actual reserves was 5, then 5 minus 2 gives us our excess reserves. A single bank can only loan out the amount of their excess reserves. So the most money that a single bank could create is $3,000, just the amount of their excess reserves. But the entire banking system can loan out a multiple of excess reserves. So we would calculate our money multiplier, which is 1 divided by the required reserve ratio. So 1 divided by 0.1, which is 10% is 0.1. 1 divided by 0.1 is 10, so 3,000 times 10, the entire banking system could create 30,000. If that required reserve ratio goes up to 20%, then 20% times 20,000 is 4,000. So we'd have 4,000 required. We still just have 5,000 actual, so we'd have 1,000 excess. A single bank could loan out and create money of $1,000. But the entire banking system could loan out a multiple of that $1,000, so we have to calculate money multiplier. If required reserve ratio is 20%, then 1 divided by 0.2, 20% is 0.2, 1 divided by 0.2 is 5, and so 1,000 times 5, the entire banking system could create 5,000. So look at the effect just right there. You can calculate the other 2 rows, but just from row 1 to row 2, we doubled the required reserve ratio. But look at the effect. The effects was sixfold between the money creation potential at a 10% ratio versus the money creating potential at a 20%. So changing the required reserve ratio has 2 effects. It changes required and excess reserves, and it changes the money multiplier. It's a very powerful tool, but because it is so powerful, it's not frequently used. So remember, the discount rate was the interest rate that the Fed charges commercial banks when commercial banks get a loan from the Fed. Typically, the Federal Reserve is a lender of last resort for banks. If they can't meet their required reserves, they typically try to borrow from another bank. Remember, the interest rate they pay another bank is called the federal funds rate. But if they can't borrow from another bank, if they can't meet required reserves, they borrow from the Fed, and the interest rate they pay is called the discount rate. These are overnight loans, usually very short term. It doesn't actually follow that the banks would borrow excess reserves from the Fed. So changing the discount rate probably has no effect on changing the money supply, but it is a signal of the Fed's intent. So if the Fed's intent is to try to increase the money supply, they're probably going to be buying bonds. They're probably not going to change the required reserve ratio, but when they change the discount rate, they're going to be lowering the discount rate, lowering that interest rate that they charge banks. And that's a signal that they're going to be using open market operations, buying bonds to increase the money supply. If they're going to be selling bonds to decrease the money supply to try to control inflation, then they would be increasing the discount rate. So paying interest on the bank's reserve account at the Federal Reserve is a pretty new tool, 2008. So it allows banks to pay interest on banks' excess reserves at the Federal Reserve. So if the Federal Reserve wants banks to make loans because they want to increase the money supply because they were in a recession and we're trying to shift that aggregate demand curve to the right, then the bank would be lowering the interest rate paid on reserves to discourage banks from keeping reserves. If the Fed was trying to use contractionary or tight money policy to deal with inflation, they don't want banks to loan money out because that creates money and they're going to want to decrease the money supply. So they would be increasing their interest rate on reserves so that the banks would have an incentive to keep more money on deposit with the Fed because they're getting paid a higher interest rate there. So here's our summary. Open market operations, that's what's most important. Buying and selling government bonds. Buying government bonds to increase the money supply, to shift aggregate demand to the right, to reach that full employment level, to deal with a recession. Selling bonds to decrease the money supply, to push that aggregate demand curve to the left to get down to full employment and decrease the price level. We said the reserve ratio changed both required and excess reserves and the money multiplier. Very powerful tool, so it's not used very often. The last time it was used was in 1992. So I told you the discount rate was a signal. Another way to say that is it's a passive tool. It announces what the Fed intends to do, but it doesn't actually change the money supply. And then this new tool, paying interest on reserves. The Fed has a dual mandate from Congress. They have a mandate to keep prices stable, so control inflation, but also keep the economy growing so that we can achieve full employment in the labor force. Sometimes this is a trade-off. If we're trying to increase the money supply, to increase the ag demand, to be able to shift that aggregate demand out to the full employment level and get everybody jobs, some price increase is going to come with that. Some inflation is going to come with that. So it's not that they want to keep inflation to zero, just stable. If we have, generally they think inflation of about 2% is probably healthy for the economy, keeping that aggregate demand curve shifting right to achieve or stay at that full employment level. So this is what I said, a 2% inflation rate is probably the best plan. That's the current thinking on what the best plan will be to keep the economy growing. You can't stay at a 0% inflation rate and keep the economy growing. The interesting thing on this slide is the Fed's target for unemployment. They've listed it at 4.3%, and that's a sliding scale. I don't want you to necessarily memorize 4.3%. As much as I want you to know that the Fed has a target on what unemployment should be that would reach our full employment level. Remember, the full employment rate of unemployment was not zero. The full employment rate of unemployment, or the natural rate of employment, was zero cyclical. Hopefully you're remembering that back from our unemployment chapter. So that 4.3% is the estimate of when that cyclical unemployment is zero, and we just have frictional and structural unemployment. It's that natural rate of unemployment. So that dual mandate, if the Fed could manipulate monetary policies such that unemployment stayed at about 4.3% and inflation stayed at 2%, they would feel successful. That's what they would like to see happen. So it's just a different way to put it. Inflation on the vertical, unemployment on the horizontal, and they're trying to hit that bullseye. In March 2019, we were better in both places. We had a lower uninflation rate and a lower unemployment rate. And so in March 2019, things looked really good. We won't include it in this lecture, but think about what it looked like in March 2020, April 2020, May 2020. So the federal funds rate, this is the interest rate that banks charge other banks on overnight loans. That's set to be a target of the Federal Reserve. So when you hear on the news all the time, Fed's going to lower interest rates. The interest rates they're targeting is that federal funds rate. By increasing or decreasing the money supply, they can have an influence on what this federal funds rate is. it's not a mandate. The Federal Reserve can't just say, okay, banks, you have to charge each other this certain federal funds rate. It's not how it works. It's a supply and demand for loanable funds, a supply and demand for money. So as that money supply changes, remember it was a vertical line, as the money supply changes, as the money supply increases, then interest rates, particularly here the federal funds rate, will go down. As the money supply decreases, that federal funds rate will go up. And then all other interest rates that consumers pay follows what that federal funds rate is going to be. So FOMC, remember that's Federal Open Market Committee, that's those 12 people we talked about, conduct open market operations, buying and selling of government bonds to achieve those targets, that 2% inflation rate and currently 4.3% unemployment rate, that target rate. Remember, when we're using monetary policy, the point is to affect GDP and the price level and unemployment. If we're in a recessionary gap and we use expansionary monetary policy, which would be buying government bonds or decreasing the required reserve ratio, decreasing the discount rate, and or decreasing the interest paid on reserves, all of that's going to increase the money supply, which will decrease interest rates, which will increase aggregate demand, which will increase GDP. It may have an effect of increasing the price level. That's not a goal, but it might have that effect, and it'll decrease unemployment. That's the cause-effect chain. Each action has another domino effect down the road. It brings everything we've done for the semester together. You can do the same thing for contractionary policy. We'll do it on another slide so I don't just keep repeating myself and boring you. But it's really very interesting when you put the whole semester together. So that market for money is how we started this chapter, looking at the supply and demand for money and how that intersection caused the equilibrium interest rate. That equilibrium interest rate will affect investment. Remember, investment is businesses buying capital equipment, and businesses can only buy capital equipment if the rate of return is greater than the interest rate. So when the market for money changes the interest rate, then investment changes. When investment changes, it changes that aggregate demand curve. Investment increases, pushes aggregate demand to the right. Investment decreases, pulls aggregate demand to the left, which affects real GDP and the price level. So we'll look, I just did all of expansionary, but since restrictive is on this slide, let's do that. So restrictive monetary policy would be decreasing the money supply. So if we decrease the money supply, then interest rates goes up. And when interest rates goes up, investment goes down. So that pulls the aggregate demand curve back to the left towards full employment is always the goal. But that's going to decrease GDP, which is really not the intention. The intention is to decrease the price level. So we'll begin to pull all these pieces together on the graph. So in that first graph, we have the demand and supply of money, or we will have. Interest rates on the vertical axis. Quantity of money is on the horizontal axis. So we have the demand for money. Here's the supply of money, 10%. Increased supply of money. Interest rate goes down to 8%. Increased supply of money. Interest goes down to 6%. The next graph, so every time we increase money supply from 1 to 2 to 3, we decrease the interest rates. That's just what we would expect. On the next graph, we're going to look at the investment demand curve, which then on the vertical is the rate of return and the interest rate. Remember, we can only invest, business can only buy capital equipment as long as the interest rate is less than the rate of return. We want rate of return to be greater than the interest rate. So we put the optimal condition, which is interest rate equals rate of return on the vertical axis, quantity of investment dollars on the horizontal. So here's our investment demand curve. So at a 10% interest rate, there's $15 billion worth of investment. If we increase money supply to the right, interest rates go down, let's say to 8%. At an 8% interest rate, in this pretend economy, investment would be $20 billion. Interest rate goes down again as money supply increases again. And at 6% interest rates in this pretend economy, investment is $25 billion. So when we look at the next graph and we look at aggregate demand curves, can you see that as money supply shifts to the right, we have more investment, which shifts the aggregate demand curve to the right? So would we be doing this in times of recession or in times of inflation? Well, if we're shifting money supply to the right, then what we're worried about is recession and unemployment. And so shifting that money supply decreases the interest rate, increases the amount of investment, which is going to shift our aggregate demand curve to the right towards that full employment level. So before we leave this graph, think about how would the Federal Reserve shift that money supply from 1 to 2 to 3? Would they be buying or selling bonds? Buying them. Would they be increasing or decreasing the required reserve ratio? Decreasing. Would they be increasing or decreasing the discount rate? Decreasing. Would they be increasing or decreasing the interest paid on reserves? Decreasing. So those are just 4 monetary policy tools. The one that we use most often is buying and selling government bonds, open market operations. So in truth, moving us from SM1 to 2 to 3 is primarily a function of the Federal Reserve buying bonds. So here is our aggregate demand, aggregate supply graph, price level on the vertical axis, GDP on the horizontal axis. There's our aggregate supply curve. So look at the very bottom where it says QF equals 900. That's our full employment level. We want to be at 900. But let's say we're currently at AD1, where investment was $15 billion. So I think that was associated on the prior graph at a 10% interest rate. So if we increase money supply, then we decrease interest rates, which lets investment go up from 15 to 20 billion, and that shifts our aggregate demand curve from 81 to 82, and we would be at full employment. So we know that QF is full employment. So we see the second graph where it says QF equals 900. That's our full employment. What if we kept increasing money supply beyond where we hit aggregate demand at full employment? What if we didn't realize it? We just kept increasing money supply. Well, interest rates would just keep going down, so aggregate demand would just keep shifting to the right. So at this point, we have this higher price level. Look at A. If we're at 83, where investment is $25 billion, then we're beyond the level of GDP necessary for full employment. It would be time for that restrictive monetary policy, pulling that aggregate demand curve to the left. So we would need then to start decreasing the money supply, to start increasing interest rates, to start decreasing investment and pulling that aggregate demand curve to the left so that we could get that price level down from P3 to P2. So expansionary monetary policy, when do we use it? When the economy is in a recession. We want a lower target for the federal funds rate, so we're trying to get interest rates to go down. So that means Fed's going to buy securities. They could lower the required reserve ratio and lower the discount rate and lower the interest paid on reserves, but this slide is what they usually do. The Fed's going to buy securities. That's going to expand money supply because when the Fed buys securities, they're giving the banks more reserve money. They buy some of the bank's securities or IRS, either way. The bank's reserves are going to go up. which means they have more excess reserves, which means they can loan money out, which is going to expand our money supply. So when the Federal Reserve targets that lower federal funds rate, it puts downward pressure on all other interest rates. Sometimes the problem is not recession. Sometimes we have inflation to worry about. If we have rising inflation, then the Federal Reserve will use a restrictive monetary policy, which means they're going to decrease the money supply. So if they're going to decrease the money supply, then they're going to be selling bonds. And when they sell the bonds, the bank or the public has more bonds, but the money flows out of us and into the Federal Reserve, which will decrease the bank's reserves, which decreases how much they can loan out. That will increase the federal funds rate as it decreases the money supply. So that increases interest rates, decreases investment, decreases aggregate demand. The goal is not to decrease GDP, but it probably will, some. But it will decrease inflation, pull that price level down. This is really just a good way to test yourself, to see if you can follow it. It's a good summary slide. So expansionary monetary policy. When do we use it? Unemployment, recession. Gives you the whole list of what the Federal Reserve could do. All of those things, if they do any one or more of them, would increase excess reserves. I knew I stumbled here. Increase excess reserves, the federal funds rate falls, the money supply goes up, the interest rate falls, investment spending goes up anytime interest rates falls, aggregate demand goes up, and GDP goes up. We can look at that same cause-effect chain. We use restrictive monetary policy when we have inflation. So the Federal Reserve could sell bonds and all those other options there, which will cause the excess reserves to decrease and the federal funds rate to increase. Money supply goes down, interest rate goes up, investment spending goes down, ag demand goes down, and inflation goes down. So make sure you can follow this chain. It's really what you are taking a macroeconomics class for. Now, we get to the end as we think about comparing fiscal policy with monetary policy. So do you remember the 3 timing lags with fiscal policy? The recognition lag, the administrative lag, and the operational lag? Well, there's going to be a recognition lag either way, and there's going to be an operational lag either way. But the difference is we really don't have an administrative lag with monetary policy. The administrative lag was the time Congress was arguing, fussing, fighting, trying to get an agreement on whether to use fiscal policy at all, and if they were going to. Did they want to increase government spending or decrease taxes in times of recession? Are we going to spend money on this project or that project? It's just a lot of political pressure and difficulties in coming to a decision. All of that is eliminated with monetary policy. Remember, we just have the 12 people on the Federal Open Market Committee who are making these decisions about buying and selling bonds. It's very swift. It can happen quickly. And it can be very flexible. They can increase the money or decrease the money supply a lot or a little, and they can do it frequently to be much more subtle than the great big changes with fiscal policy. So we've used monetary policy a lot in the last decade. The recession 2007, 8, 9 gives us a lot of historical data several years past so that we can look back at it and try to measure it, decide if the Fed did a good job or a bad job. There's a lot of different feelings about it. But the fact is that the Federal Reserve used a lot of expansionary fiscal policy, and they did keep interest rates very low, which let our economy grow and eventually did get us out of that recession. It's not as quick as we want it to be, but it's certainly better than doing nothing. We talked about the problems of the lags. We still have the recognition and the operational lag. We haven't talked about cyclical asymmetry yet. Asymmetry is just when things are not equal on both sides, right? So the Federal Reserve can use restrictive monetary policy and it be pretty effective at decreasing the money supply and eventually then decreasing the price level. We're pretty sure that the process will work. But the process gets a little stalled out, which is why the recession of 2007, 8, 9 was so prolonged. It gets a little stalled out with expansionary monetary policy. So the Federal Reserve can absolutely make sure that banks have more excess reserves by buying bonds. They can make that happen every time. That's no problem. What they cannot do is make the banks loan out the excess reserves. If banks are not feeling like that's a profitable condition for them because of the economy, then they may not loan the money out even if they have excess reserves. And they can't make businesses or you or I borrow the money. So while they can make the money available, they can't make banks loan it out or you and I borrow it for it to be able to move through the economy. So we say that monetary policy has cyclical asymmetry because it's a smoother, more successful process as restrictive monetary policy than expansionary monetary policy. So this is really just putting what we've done all semester in one graph. So you learned that aggregate expenditures was consumption plus investment plus net export plus government spending, and that all became our aggregate demand curve. And our aggregate supply curve is affected by the resource prices, land, labor, capital, entrepreneurial ability, the price level of those resources, how productive the workforce is, but also the legal and institutional environment. What are business taxes? What are the environmental protection laws or other laws that affect trade? We have one side affecting aggregate supply, the other side affecting aggregate demand, and it's the intersection, the interaction of those two forces that actually determines the level of output. That's GDP, our employment level, our income, and our prices.